So to summarize all the IFRS for those who have not heard our earlier discussion, the effort will be to note down the key points from all the key accounting standards or IFRS in the form of the PPT, and then I will also give some question and answers to discuss in the live session. And ultimately, you can attempt to answer those questions and also add any other question or doubt you have so that we all can discuss together. I'm not trying to go through the entire PDF because that will take a lot more time and it will distract us as well, since we have a lot to cover in this 2-hour session. There will be another 2-hour session tomorrow as well, but I would try to, that's why highlight key points from each IFRS. And that's the model I'm trying to follow. Let me know if you have any other questions or you want a different approach as well. So as the starting accounting standard, I would like to introduce IAS 1 and then IAS 8, because IAS 1 is about presentation of the financial statement. I'm also going to talk about IFRS 1, which is for first time adoption of IFRS. So in this regard, let's start with IAS 1 and we'll talk about IAS 8 subsequently. At the end of IAS 1 and 8, I will have some objective question for everyone to attempt. So IAS 1 for the presentation of the financial statement. As you can guess, this standard in entirety, presentation of financial statement, this deals with how to present the financial statement under IASC or IFRS framework. Okay, so before we go into any detail, we can just intuitively understand what it would require from us. Because once we start from, it's called the first principle approach. What we intuitively think the presentation of financial statement should include as an accountant. What is our first guess? Let's start from there. Right. So there I see as an accounting professional, we can find out that every set of financial statement should have one balance sheet, P&L, statement of changes, in net asset or net equity, cash flow, and finally notes. The purpose of the note is to assist all the above 4 and also to disclose and elaborate anything, all the numbers which cannot be explained on the face of the financial statement. Because even though we say that there is a footnote under balance sheet and the P&L, ultimately any footnote cannot really provide the nitty-gritty details of a balance sheet number, right? Hence, the notes is integral part of all these 4 primary statements. These are called primary statement 1, 2, 3, and 4. And disclosure note assist us to interpret and understand in more detail the numbers represented in the 4 primary statements. Okay. Now, once we have the 4 primary statement presented, we also need to obey or follow certain rules. And what they are? Some of the conceptual framework of IFRS, secondly, rules of IFRS to prepare account. Now it seems that what are those rules then? Accrual concept, matching concept, going concern, prudence, and we'll keep adding more rather than just making the list. So basically, accrual says that the income and expenses should be matched in the period they occur, or they should be matched so that there is no delinking between the two. Like if expense is recorded for a period, we need to consider the income of the respective period, and vice versa. For example, if the organization is operating and the admin fees or maybe the rent of the building is not paid in that period because the office was closed due to corona or pandemic, it doesn't mean that if we have not paid, we should not account for the expenses. And that accounting for the expenses means we need to follow accrual concept. And if there is any issue with the accrual concept, we need to follow the idea of matching, because the revenue and expense and the cost should be matched for the same period. Then comes the going concern basis. Generally, we need to consider that organizations are able to operate in the long term. If it is not going to operate in the long term, it is not on the going concern basis. Why the going concern is important? Because if we don't consider the going concern, we have to consider the financial statement or prepare the financial statement on breakup basis. So going concern is another fundamental concept of IAS 1, because the valuation, the pricing would be different when the organization is at going concern versus at the breakup basis. If I consider that the organization is on the breakup basis, means they are going to file bankruptcy, my asset and liability will have a different value as compared to if an organization is at going concern basis. Going concern basis means there is no problem with the organization, and it will be able to sustain long term. So that's why this approach is taken for preparation of financial statement. Prudence. Prudence says be conservative. And what I mean by that is, when we are conservative in terms of asset or revenue, we try to take a more kind of a pessimistic view. Means we don't try to take a very inflated view of revenue. We consider all the downside of the asset when we calculate the fair value. So prudence says take a conservative view of revenue or asset and consider the worst case scenario when it comes to the liability. Extreme for liability. Because if the liability for any reason is inflated, it will impact the organization, and hence investors or the users of the financial statement should know what is more likely or what could be the worst of situation for the given liability. So the prudence concept needs to be followed not only for the liability, in fact for asset, liability, revenue, expenses, all the numbers that we are talking about in the 4 primary statement should follow prudent approach. So prudence is another fundamental idea of IAS 1. So it talks about the 4 primary statement, how to organize that, what to classify, and how to prepare these numbers. So let's cover a couple of other key concepts. Offsetting is another concept which is prohibited in IFRS and IAS framework, but we will talk about how to still account for any contract which can be settled. So offsetting is another concept, or netting off. Generally not permitted in IFRS. So when you prepare a balance sheet, all the asset and liability should be shown separately, even if these are with the same counterparty. So who are the counterparty? Normally, if you are dealing with a bank and you have a set of asset and liability, both with the same bank, right? So what is the asset? Say $100, and liability is $30, right? Do you prefer to show a asset of $70? Whenever you wish to unmute and speak, please do so. So if you have an asset and liability of $130 respectively with the same bank, say it is Citibank or State Street, Goldman Sachs, or JP Morgan, would you like to show $70? Quite possibly many people prefer to, but IFRS do not permit that. No netting off
Sir.
allowed.
Sir.
Yeah, please proceed. Yeah.
So I have just now joined that meeting. I want to know that which topic are you studying?
IAS 1, presentation of financial statements.
Okay, so thank you.
No problem.
Please continue.
Sure. So basically what I'm trying to say is that normally we prefer to show offsetting because it will kind of show the net impact of the asset and liability, but IFRS do not permit that. Many other accounting standards such as US GAAP permit netting off, and IFRS has a clause that it can allow netting off only when there is a master netting agreement, something called M&A, which is in place. We'll not go into the details of M&A, but yes, it does exist. If you have an M&A, then net off is permitted under IFRS. Otherwise, it is not permitted. M&A is important for netting off, or actually indispensable. It is required. Okay, so that's one concept. Then materiality. Materiality is about two aspects. Qualitative and quantitative. Since IFRS is very much a concept or a principle-based accounting standard, it allows you to present the financial statement which provides all the key information. Any material or important information should be provided. It is not rule-based, it is disclosure-based. That means if you think any information or the number is important for the financial statement, if it is important for users to know, please show that, please reflect that, regardless of what the rules or rule book says. So, and when it is about the qualitative, it is about the materiality of the information, it is not just on the basis of the number, right? Imagine a situation when an auditor visits a branch of the bank and finds out that though the revenue of the bank is say $1 billion, okay, but there was a fraud in the bank to the extent of say $5 only. There was a fraud of $5. Somebody just took the money from the bank and it was never detected, even despite all the CCTV camera, etc. Now, quantitatively, is that big number? No. But qualitatively, is that important? Yes. Because quantitative aspect talks about the number, the volume, okay? But qualitative aspect talks about the importance of that disclosure, the activity, that event, that incidence. So that's why you need to judge the materiality on the basis of the qualitative and quantitative both aspects, and then you can judge whether an event, a number, or disclosure is material or not. Just because a fraud of $5 is a small amount, it doesn't mean that it is immaterial. It is still material because the qualitative aspect, on the qualitative ground, I see that it is a massive breach of control in the organization, in the bank. And today it is $5, tomorrow it can be 5 million of the fraud. So it should still be disclosed that there was a breach of control in the bank. Of course, that's a different matter whether we do or not, and what not. But when we discuss about the materiality, qualitative and quantitative both aspects should be touched upon. Next comes the presentation consistency. So consistency, a key aspect of the accounting standards, IS1, because when we have a balance sheet and the P&L for 2001, and then another state of balance sheet and the P&L for 2002, often we see the argument that you know what, in 2001 we disclosed it, but in 2002 we did not think it is important. Okay, and 2001 we also disclosed it because the number was big, but in 2002 we did not disclose because it was small. That kind of argument is inconsistent. In IFRS IS world, we need to stay consistent year upon year when it comes to the treatment and disclosure or recognition of the numbers. So consistency should be maintained. Okay, and that also brings me to another point called comparative. IFRS requires at least 2 years of disclosures. What does that mean? 2 years of disclosures. So when you have a balance sheet or P&L number, so balance sheet, P&L, or even cash flow, this needs to be prepared for current year as well as previous year, CY, PY. That way, we can always compare the two number, how it is flowing year on year for comparison purpose. There are other rules how and when we can show even prior to previous year's number. In exceptional cases, as per IAS 8, sometime it is required. We'll talk on case-to-case basis. Anyone wants to add any other observation from their experience about financial statement? Of course, we need to also add name of the reporting entity and whether the financial statement covered the individual entity or a group of accounts, right? Sometimes there should be a subsidiary or the parent account. There could be consolidation of the accounts. We need to disclose those information. What is the reporting date? Generally, it can be 31st of December or a different date based on the local financial year. So we need to talk about what is the reporting period of that financial statement. For example, so there is a very good question here. In terms of consistency, there could be certain set of mandatory disclosure as per the IFRS. So that will help in the consistency definitely, because after all, IFRS 7, which talks about all the accounting disclosures, right? And then we have different disclosure notes like credit note, liquidity notes, offsetting tables. So this helps us to stay consistent. But again, in the credit note and liquidity notes, what we show, it is up to us. And this is where often accountants take the decision which is not consistent. So no matter how much accounting standard will like you to stay consistent, sometimes people go a tangent, take their own road, and go to the farmhouses, leaving the railway track. And for that only, it has been emphasized that, hey, be consistent when there is a disclosure about the number. Okay, so other item that we need to also consider as per IS 1 is presentation currency. Choose the presentation currency which is right, and we will learn about the forex transactions presentation currency in other standards, IS 23. But presentation currency is important aspect of IS 1 as well. Level of rounding, even these are important decisions to make. How many decimal places you are going to show numbers for? How many decimal places? Reporting period. These are another salient piece of information which is important. If some accounting policy is applied retrospectively, we'll deal with that in more detail. But if you are applying any accounting policy retrospectively, then all the changes should be checked for other part of the statement. For example, to clarify, imagine that we change the depreciation method, right? We decided to change the depreciation method from straight line to reducing balance method. What we need to do? A, be consistent, apply the same method to all your plant and equipment, and B, restate the number for previous year financial statement. Do you remember? You promised to show 2 years of the financial statement here, current year and previous year. If you decide to change the depreciation method, which is a change in accounting policy, you change the number this year or you change the methodology this year, but you need to also do the same for previous year, because your accounting numbers will be different for PY, and you cannot keep the same PY number as per the old accounting method, and you cannot just change the depreciation method for this year and keep the last year number as it was. No, you need to change the PY number. If you change the PY number in the balance sheet, your P&L will be changed, right? Then your line items in the cash flow will change. The net cash flow will not be impacted, but line items within the cash flow will be impacted. So all those things need to be consistent as per IS 1. Let me give you an example of how the balance sheet and all these accounts will look like. I'll show you the excerpt of primary statement. So now can you see and correlate to what we were talking about? So 2018, 2017, and 2016. Let's ignore it for a minute, and we'll talk about that why it comes sometimes. But generally, you will see 2018 and 2017. So, for instance, you made the change in the property, plant, and equipment because your depreciation method changed. Depreciation method changed. That will also impact your P&L. Did I bring it here? So as you can see, your cost of goods sold, operating expenses, all these numbers are related to expense for the year. So operating expense, income before tax, they are impacted by the depreciation method that you choose. So what I'm saying is for 2018, when you make any change, you have made the impact for 2018, but your 2017 numbers are still reflected as old number. So if you make change in 2018 policy, you also need to make the changes in the number for 2017 and check that all the financial statement and all the numbers are adjusted, because sometime you make change in one place and it will flow through the entire financial statement, FS, notes, report, even compliance reports are changed. So need to be careful and check and develop a checklist so that all relevant places are impacted accordingly. So what you need to do at the end of the day, recalculate PY number, previous year number, or restate. In fact, this is called restatement as well, PY number. So all your 2017 number will change. Even your disclosure notes will change. Some might argue that, oh, does that mean that I have to really restate the entire financial statement? Answer is yes, you might need to. And I can't give a better news. I can't give a good news here. Sometime one or two number you just change and entire financial statement will be changed for previous year in IFRS world. And yes, we have to deal with that. Of course, with experience, you will know which number are going to change, but that comes with experience. But till then, have to just bear with the reality. And we don't have any other shortcut for this. Let me move to the previous PPT I was using. By the way, any questions so far? Is this Saturday afternoon making everyone sleepy?
Hello.
Hello, yeah.
For me, no question. I'm just coming online due to the time communicated in one of the forums.
Oh, okay.
So I don't even know which module are you discussing?
We are talking about IS1. So
okay,
yeah,
okay,
right.
good.
You have not lost much. So IS1, the financial statement, how to disclose, what are the rule of thumbs to prepare the financial statement. So we are going through that.
Okay, good.
There's some question, I think.
Sir,
Yes.
sir, if we change the method from 10% SLM to 5% WDV, then what is it? Accounting estimate, yeah, accounting policy. We should go with change in method or change in percentage.
All right. So can we hold on this question, because after IS1 I'm going to talk about IS8.
Sure, sir, sure.
Yeah, and it's a good question, but it's a very relevant one as well. So IS8 is going to talk about accounting policy, estimate, etc., and how to handle those aspects. So we'll tackle that in more detail. So I'm sharing the new PPT, right? Are you able to see the blank page? So just to clarify, to those who have joined later on, the class will be for 2 hours, this class, today's class, and then there will be another session of 2 hours tomorrow. So 4 hours I am intending to spend to cover all the financial statement, all the IFRS statement. Of course, it will not be as detailed as it will be for the entire long-term session, but I would like to just cover all the key points for major accounting standards. Altogether, 2 hours, 2 days. Okay, so back to IS1. There are certain rule of thumb when we start to prepare a statement of financial position, and that is when we prepare the current asset. How do we reflect the current asset? We need to take. Hello, yeah.
Just a concern from my end. I don't know.
Sure.
Because looking at IS1, we have other standards that you must have gone through or you must have known before ever you can get grip of IS1 completely, the footnote, especially the footnotes. There are other IS that you're supposed to have known, like PP 16, 17, IFRS 5, IFRS 16. I think those standards are equally important if someone needs to know IS1 totally. I don't know. It's just my opinion. You can advise better.
That's the right one. So IS1 is just to give a very bird's eye view on the what do you call the rule of thumb, how to prepare the 4 major statement and notes. Then, of course, as you said, we have IS 36, 37, then 21. So for inflation, FX, intangible, tangible asset, there are various other accounting standards which will talk about how to treat each number or each type of asset, each type of liability, how to disclose, how to recognize. So all those standards are equally important, but IS1 just gives a very high level guidelines how to start preparing the financial statement, and then the specific standard will provide the further details. It's just like the world map. So once we have the world map, then if you want to say go to Europe or any such country, you can buy the local map as well. So just like that.
Okay.
All right. So back to the IFRS, sorry, IS1. Some key points I just want to highlight. And there, maybe you can note it down. So current asset, how to disclose that? There are three, 4 types of current asset, and we need to disclose separately as a line items, and they are held through maturity. So when we show any particular asset in the balance sheet, we need to reflect them as one of the 4 heading. For example, held till maturity. Fair value through profit and loss, and then fair value through profit and loss through the comprehensive income. Okay, so that's then comes another term or FVTCI, because there are two type of fair value reporting. One goes directly into the P&L, another goes into the comprehensive income. Why the comprehensive income? Because there are certain number which is reporting it into the financial statement, like a income statement. We still report these two into income statement, but fair value through P&L goes top side, and fair value through the P&L through comprehensive income that goes into the bottom. What is the difference between the two? Anyone?
Items included in OCI generally don't have a cash impact on the profit.
I know where you're going to, kind of, but just to clarify, even those items which are in OCI or other comprehensive income, when they are sold, right, they will have the cash impact. It will go to the, then it will be classified from OCI to income statement, and it will also have the cash impact. But kind of number which goes into OCI is more long term or kind of non-immediate basis. That will be a kind of a more accurate way to explain, and I'll tell you why that is more long term. Say for example, how many of you are working and you pay or you see the deduction in your pay slip for provident fund? So what happens when there is a provident fund or any payment deducted by employer for PF? Generally it is defined as two: defined benefit and defined contribution. Okay, when the employer has a defined benefit program, they have to maintain certain pool of assets, because they have to assure you as employer that when you retire you'll have certain payment every month. Okay, good news. For that they need to maintain a pool of asset. Sometime because of the bad market, pool of asset can go down and employer has to incur more expenses. Are you with me?
Oh yes.
Yep.
Yeah, so you can see, and this you're not going to retire immediately, you agree? It will take 20-30 years. So when the assets are going down or up, etc., don't you agree it is temporary? And if it is temporary, why to impact this guy or person fair value through P&L? You can just throw it under OCI, other comprehensive income, right? When it will come and hit, it will hit. So that's why we keep it in the OCI and not under the P&L. So this kind of classification is needed on the face of the primary statement. When I say primary statement, like balance sheet, profit and loss, cash flow, and statement of changes, we need to keep the header like held till maturity, fair value through P&L. There should be separate line items maintained in the balance sheet. And once you have a line item maintained in the balance sheet, you need to maintain similar line items in the P&L as well. Why? Because if you have, say, two type of assets, right, in the balance sheet, you need to have similar unrealized gain and loss, so you need to maintain same kind of list of assets and the disclosure in the balance sheet and P&L. in order to be consistent. So I was talking about OCI. So it is not only about the defined benefit and the pension. OCI also includes something like for FX translation gain and loss. So defined benefit and gain and loss on asset held till maturity. Okay, so anything which is long term, anything that is not going to impact immediately, but still is a loss or gain for your organization, that will be going into OCI. This is how we categorize OCI. But in the P&L, it is important to have two separate places for this. Current liability, how do we disclose items in current liabilities? Any idea? Anything that settles in 12 months, that will go into current liability. Or if it is going to be settled within normal operating cycle. Such as overdraft, bank overdraft. Third item, loss due to trading. Generally, what kind of loss you can make due to trading? If you are an investment company, okay, imagine you have invested into futures. Invest in future or option like derivatives. In that course of trading, you might incur some loss. That will go as a liability in the balance sheet, and you can classify that as current liability. Similarly, now there are some rule of thumb for income statement as well. So an entity can present all its income and expenses for the period either in a single statement of comprehensive income, or you can break it down in a statement of profit and loss and other comprehensive income. Now, why I'm giving these two statements? Like earlier we talked about having OCI, and now I'm saying that you can keep it under the statement of comprehensive income, as well as you can have another approach. The point is IAS 1 gives you the flexibility. I mean, praise of IAS 1, but oops. IAS 1 gives you flexibility to either show everything in one statement called comprehensive income, or break into parts, just like we talked earlier. But if you choose to follow this, you have to provide a detailed notes anyway. So there is no escape ultimately. You have to highlight anyway. what is the fair value through P&L, and so fair value through P&L and OCI. Both you have to provide, whether you provide in the P&L itself, or if you choose to provide everything in like one single statement in one single go, then you have to provide a detailed disclosure note saying that, okay, how much should have gone into OCI. Am I clear? Any question on this? Another selection that we need to make is entities need to choose between the function of expense and nature of expense method. Okay, what is the difference between then function and the nature? Anyone? Function is called when we are talking about, say, various departments like admin fees or professional fees expenditure. That will go as the function. But if we talk about, say, nature means sales returns and allowance, cost of goods sold, operating expenses. So when we are talking about, like, as a classification, as the nature of the expenditure, for example, cost of goods sold. Now under the cost, you might have all the professional fees. You might have legal fees. So that goes under the nature of expense. But if you want to disclose as different function, then what would you do? You'll talk about the legal, taxation, R&D, all separately. Is that clear? So I see a couple of messages actually popping up. I'm not able to regularly open this, so I would still encourage everyone to just unmute and talk.
Hi Nidish, could you please repeat this? You were explaining regarding nature and the other aspect.
Okay, so when we talk about the nature, so any P&L, all right, statement of comprehensive income, which is a P&L, any P&L need to select between how you want to disclose the expenses. You want to disclose the expenses as the nature of expense, or you want to disclose that as function of expense, right? So expenses are displayed in the P&L or the statement of comprehensive income in two manners: nature and function. Okay.
You mean under two heads?
No. It is like this. Either you can choose expenses to show as nature of expense. Let me give you an example here. I can have revenue, okay, 500 million. Then I say cost of goods sold, minus 120. Then I might have other expenses, another 150. What is this? This is talking about the cost incurred without telling us the different functions. So this is about the nature, right? Because I'm talking about the goods sold. What was the inventory cost of goods sold? What was the inventory cost? Then I say other expenses, maybe some admin expense, all the expense clubbed together. So this is nature, right, of expenses. Next, I can have another type to show this. Revenue remains the same. So you can either club it by nature or by function. Then I'll say admin fee tax fee, legal fee. Now what I'm showing here,
Separately you're showing, right?
yeah, separately, but it's not separate only, it is a function. I'm reflecting the different functions of the expenditure. In
You
that
mean
way,
either particular function, I mean
or
particular admin, or we can club it into single heading like other expenses, correct?
yeah, then it becomes nature. Here it becomes function.
Thanks.
And that
Hello.
is an important selection, but you have to do the selection. You can't keep changing this as well. You have to make a selection and follow it year on year. All right, so we have talked about the fair presentation and compliance, going concern, accrual basis of accounting, consistency, materiality, offsetting, and comparatives. Okay, and different kind of financial statement that is required for IS1. All righty. So I also promised to talk about memory map. Okay, so this is the memory map I was referring to. This kind of memory map is important to understand and grasp the entire IFRS or one accounting statement at a time. So since we have 40 to 50 different accounting standards that we often need to learn for any diploma or certificate program, we need to get accustomed to use this kind of memory map or prepare one for ourselves. Okay, I'll post it to a few groups as an example, and we'll expect everyone to kind of develop this kind of skill. It will be just useful to develop good memory techniques. Okay, so all the concept I talked about, that is here broken as a useful and memorable items and good visuals. It will help you memorize and retain these informations longer, and it will take less time if you want to revise it as well. So revenue, finance cost, tax exemptions, how to show statement of comprehensive income. So that is your traditional P&L. This is your statement of is. Then this is all the key concept or key rules for IS1. General information accounting policy, judgment, purpose. What is the purpose of the account IAS? And that is financial position, performance, cash flow, notes, and then we talk about the different framework of IS1. Going concern, we talked about accrual basis, materiality, offsetting, frequency of reporting, all these aspects. And here comes your balance sheet. What you cover under balance sheet? Asset, liabilities, and equity, and presentation. See, in one picture you have covered almost entire IS1 and easy to remember. Moving on to another statement, another standard now. Let's IS 8. So IS 8 is all about accounting policy, changes in accounting estimate, and errors. So often, as we do and prepare the accounting statements, we can make errors as well. So it is very explicit that it covers policy, estimate, as well as the errors. Have you prepared the financial statement? Have you encountered any error and how it was treated? Anyone from your experience? All right. So changes in accounting policy which it deals with is accounting policy must be applied consistently to similar transactions. So again, we are back to consistency. Then comes a change in accounting policy is reflected in the financial statement well in advance. Okay, so often you will see that accounting statement will talk about we are going to adopt, for example, maybe IFRS 17. So some of the financial statement would try to pre-announce that we are going to adopt this accounting standard, and implications will be such and such. Implications will be ... right, from this date. So we can all talk about the accounting pronouncement in advance, and you'll see many accounting or financial statement actually do have that section talking about the accounting policy that we are going to adopt. Now, another aspect is sometimes an entity choose to adopt an accounting standard in advance or accounting policy in advance. It is required to apply that policy. How? Retrospectively. What does this mean? For example, if you're reporting for current financial statement, suppose 2020, right? And you choose to account something retrospectively. So what happens? You have to also reflect 2019. That is a rule of thumb for IFRS. And if you need to imagine reflect an accounting policy retrospectively, means all the number for 2020, then all the number for 2019. Don't you need to also do the calculation for 2018? How many people think yes, and how many think no? Because your opening numbers for 2019 will also be impacted. Agree? Every year you need to account, you need to provide the financial statement for current year and previous year. Plus, if you make any change in accounting policy, you need to do the retrospective calculations. Retrospective means your opening number for 2019 also need to be recalculated, because you are changing the accounting policy. If you need to recalculate the 2019 opening number, what will happen? Your 2018 closing need to be restated. In accounting terminology, we call it restatement. So if you choose to apply an accounting policy in advance, especially voluntarily, it is called voluntarily adopting in advance.
Nidesh, I have a query. I mean, if you say reinstating, for example, it is 2020 is current. So prior to we have to prior 2 years we also need to make changes, correct?
Correct. And but more important is that you know the reasons, right? Because you need to make the judgment yourself in the future in such situation. So why you need to restate 2018? And you don't need to recalculate all the numbers. You just need to find out the closing number for 2018. Okay? Because ultimately you only need to reflect 2019 all the numbers, and you need to check if the opening number for 2019 is correct or not when you change the accounting policy. And hence you need to also check the closing number for 2018 for accuracy. That's why 2-3 years are impacted when you decide to change the accounting policy or adopt voluntarily before the accounting standard is in force. Because sometimes what happens is you are asked to adopt new accounting standards, say by 2022. But if you think adopting in advance gives a better, true and fair view, you are allowed to adopt in advance. But here is the disclosure. You need to adopt it for all the current year, previous year, and also restate the number, closing number at least for 2018. Okay, couple of point to note. First, let me clarify the difference between accounting policy and accounting and estimates. So somebody had asked me some 10 minutes ago about this. So now we can talk about that question. So let me discuss this. I bought a truck. Not the right picture, I think. Okay, imagine this is like a truck, okay, 5 minutes, and it is for 10 million, any currency. Someone tell me what is the useful economic life. Let's say it is 10 years. All right, what will be the depreciation? So 1 million per year. That will go to my P&L. Now, after suppose the truck was bought in 2011, 1st January. Like, can someone please go on mute? Okay, so now with this, in 5 years, by 2015 end, there is a depreciation of how much? 5 million. Sorry, I was trying, it was frozen for a while. I was trying to switch to muted mode. All right, so 5 million of the total depreciation, and start of 2016 we realized that we need to change the total value of or maybe the life of the truck. Okay, initially we envisaged the truck is useful for 10 years, right? Now I want to estimate this useful for 15 years. Sorry, I had to mute everyone for a minute. There was so much noise in the background. Can you please all remain muted when you don't need to speak? There's a lot of background noise. And since I'm sharing and I'm also using writing pad, so it freezes. I'm not able to mute very frequently. So appreciate your help. Thank you. All right, I'm just going to start screen sharing again. All right, so while I'm doing the screen share, we decided to hello, can you hear me?
True.
All right, back to business. So we changed the account, the entire life of the truck. Okay. From 10 years to 15 years. I'm trying to decide whether it is a change in accounting policy or estimate. Can someone help? There's no change in policy yet. The change in estimate, because the number has changed.
Yeah.
The useful economic life. The right term for this is useful economic life. That has changed. Or maybe I can change the scrap value. Scrap value of the truck. That's another change I can do. Or the third change I can do is what else? Sorry.
Depreciation method.
No, I will factor that one later on. Thanks for adding. But in the estimate only, I'm just trying to stay in the estimate section. I'm just trying to change the estimates. So I change the number of useful economic life. I change the scrap value, and the third thing I can also do. Value. Change the carrying value as well. Yes. Right. Because if I change the carrying value, ultimately how much goes into your balance sheet or P&L as a depreciation will also get impacted again. But one thing that you need to note is, and that is a key point of the entire IS 8, because in this you are not changing the method. Did you notice when someone said quite rightly though that you can change the depreciation method, but then I said that let's wait for that for a minute. Because when we are changing the estimate and the number of years of the truck or useful economic life or the scrap value, you notice we are just changing the numbers. And when you are changing the number only about the truck, year, life, scrap value, you are changing the estimate. But then comes second point, depreciation, but that is not change in estimate, that is change in the accounting method. Now why we are kind of discriminating between the two, between estimate and accounting method, because there is a massive difference between the two. When you change accounting method, there is a bad news. And bad news is you have to make the retrospective change. Remember it. It is highly examinable. Retrospective change. What is a retrospective? You have to start making changes for previous years, and not only 1 or 2 years. Let me make it worse. Probably I'm just giving the bad news. When it comes to retrospective year, you have to look into the start date every year of depreciation for depreciation. Because if the truck was bought say in 2011 and it was say for 10 million, and you change the accounting method from straight line to reducing balance, right? Do you agree that you need to start accounting from 2011 to 2017 if you have made the change in 2017 in accounting methods, right? Do you agree? Because straight line is what? You have a truck for 10 million to be depreciated in 10 years. Every year, per year, your depreciation is 1 million. But when you adopt reducing balance method, you need to kind of say depreciate every year 25%, okay, of the carrying value. So my first year of depreciation 2.5 million. Second year 25% of 7.5 million, right? So on and forth. So second year is 25% of 10 minus 2.5 million, right? Now next year 25% of this number, like remaining number, okay? Or let's say 25% of 75% of 7.5 million. So this is how for third year. For fourth year, it will continue like this. Percent of. So don't you have to make the calculation from year 1 till date, right? And then calculate it for 2018 to arrive at end value, then update 2019 opening value, and then update financial statement, prepare the financial statement for 2020. So this is how we go about calculating reducing balance and accounting policy. So when you make the change in the accounting policy, you need to change, of course, current year you have to change, previous year you have to change, previous to previous year you have to restate, and also do the calculation for all the years. When you do the changes in accounting policy. Well, I'll give you some relief. If there is a change in accounting policy due to the change in accounting standard, the change in accounting rules, change in Companies Act, regulations, by law, right? Then you don't have to do kind of retrospective changes. You just need to change current year, previous year, and that's it.
Nitish, I have a query over here.
Okay. Apart from the depreciation, what are the changes needs to be done, right?
Correct.
Yeah, I was coming to that. Good question though. So depreciation is only one example of change in accounting policy. Though it is one of the very frequent and easy to understand as well, but depreciation is only one of the change. You might have various other changes in accounting policy. For example, you want to measure all your land under held till maturity. You just change the policy, okay? Or you want to hold all the collateral. So various investment company also do this. You want to hold all your collateral which you have given to someone as asset, and you just want to treat all the cash that you have received as liability. Now I'm talking about this because sometimes what happens, you want certain cash. Yeah, Tanvi, you can speak. You borrowed cash and given some securities as collateral, okay, to someone else. So generally we reflect the cash as asset and security is not reflected in the balance sheet. But you might change the policy. You can say that, okay, all the cash is liability and all the security is your asset, right? That can be a change in your policy. And if you do so, you need to implement that retrospectively. Similarly, there are various such policies which can change time to time. Make sense? Someone, Tani, you raised the hand. You want to add a point? Inventory valuation, someone said there's an entire gamut of the valuation methodology which can change. You can also go from FIFO to LIFO or vice versa. There are various ways you can change the methodology, but that is more cumbersome if you change the accounting method. Estimate is easy. When you change the estimate, you only have to apply that prospectively.
Yeah, hi Nidesh, Raja this side. So basically, I mean, I have read somewhere as per, I mean, US GAAP or maybe IFRS, LIFO is not permitted.
Yeah, so LIFO is not permitted when the inflation in the entire economy. If you still have a justification, if there is a deflation and you can justify, only then you can use the FIFO. So, or you can provide the LIFO reserve. So there are some exceptions, but you can still use if you have those justification. But in terms of accounting method, you might change between LIFO and FIFO. So as a policy change, it will still require the entire restatement of the number if you choose to make any switch. For example, I think someone also talked about valuation method. So one could be LIFO and FIFO. It is not completely banned, but it gives the flexibility to choose. Of course, IFRS has very little restrictions on any particular method. So if you can justify the use, it can still be used in both way. But of course, for the inflation impacted economy, it has its own preference. That LIFO is not generally permitted because it does not provide the right costing method for the P&L. So that's the approach. But yeah, when it comes to the valuation method as well, someone mentioned that valuation can trigger the change in accounting policy, and the answer is yes, because when we have derivatives, equity and fixed income like bonds, you need to use extensive valuation methodology. And if you change those valuation method, again it will trigger IAS 8, change in accounting policy. So there can be various situations when accounting methods require a change, and it can often be cumbersome, but you need to be ready to at least restate or maybe calculate in a fresh manner current year and restate the previous year as well.
Nidish, this derivative equity and FI bonds, you were trying to explain that there can be changes in their method like FIFO to LIFO easily.
No, yeah, the two things got mixed. So
Okay.
the valuation method I'm talking about for options, future, derivative, and fixed income, they are basically based on the derivative valuation, like swap, right? We value swap, we value options. So they are valued using some Black-Scholes-Merton model for options. Swap is valued on the basis of the net loss and gain to the respective party based on the floating or fixed interest rate. So the valuation methodology there for the derivative can change, right? And if we change the valuation methodology for the derivative, again, that will trigger IAS 8 requirements. Their LIFO is not relevant because the OTC or any such contracts are between one organization to and the other side. There could be exchange or there could be counterparty. So LIFO is not relevant in that context. Does that clarify?
Yes, thanks.
Okay. Now, the other thing we missed as of now, prior period errors. So accounting policy and change in estimate we have talked about. There are certain changes which is required by force if we made any error in the previous years. And it could be error or it could be because of the lack of information. If that happens, we need to make changes in the prior period. Of course, it will also change the number in the current year. And if we need to make a changes in the last year, which reflects the change in accounting policy, then you need to reclassify all other similar numbers as well. And it makes rational sense, right? So what I'm saying is, because of the error, you need to make change in PY, which is 2019. Then for same category of asset, or liability, or for similar expense, you need to adopt consistent policy and make all relevant changes, because cherry picking is not again allowed. We cannot choose and we can't say that, you know what, for my customer called A, we had over accrued the income or revenue. But imagine you have customer B, C, and D, and for that you might also have over accrued. So you need to make the changes for all the customers and the clients, because you must be having a rationale behind making the correction in the error. If you go into the deep in the rationale why it is required, because often it can be used to make the changes in the favorable manner by the company and the finance directors. They can choose to switch back and forth in accounting policy and the estimate every year, and can say, oh, you know what, last year we made an error and it should have been a different number. Yes, it could have been different number, but then it should be applicable for all the relevant clients, for all the same classes. Now, a couple of challenges comes, that what if the accounting policy that we are trying to follow with regard to, say, mine, minerals, agriculture, everything, sometime we might not have accounting policy at all for a particular industry. So what should be done? So their rule of thumb is that in case of lack of the standard or IFRS, one need to consult or check other IFRS or IS standard, basically, which can give some light. For example, we know that there is a more specific R&D related standard for software industry. There is also a generic rule for R&D for all other industry. Imagine that somebody is working on some space shuttle or doing mining on the other planets, right? Because these things are actually happening now. It is not a sci-fi movie. Some companies, some countries are trying to do the mining for or on other planets, finding out some titanium or gold, etc. And there is no accounting standard for them. How do you think they will be operating? Or maybe someone trying to find out a different planet to live. So in the cases when the accounting policies are negligent or absent, IFRS suggests that we follow other similar accounting standards, which is closest for that industry. That's first step. Second step is, if you still don't find out a similar accounting standard, then follow the overall conceptual framework of IFRS. What IFRS suggests, like true and fair view, substance over form. Do you all know substance over form, right? Substance over form means the trying to show the economic reality over the rules. So when the rules and economic reality are in conflict, the auditors and accountants are supposed to reflect the economic reality. Forget the rules, because IFRS is rule based, sorry, principle based, not rule based. The example of the rule based accounting standard is US GAAP. Okay, so try to reflect the economic substance over forms. And still, if you don't find out or there is a confusion, then you can apply a similar accounting standard from other accounting bodies, maybe UK GAAP. And another information you should note is IFRS is closest to UK GAAP. It has been actually patterned when the IFRS was being developed. The closest accounting standard it was kind of checking against, or it was patterned on, was UK GAAP. So you can check with UK GAAP as well. So these are some rule of the thumb to apply when deciding on accounting policies. Okay, so what are the different disclosures required for IS 8? Title of IFRS, nature of change in accounting policy. So what kind of change we are going to make if there is any change in accounting policy? Why that change is needed? So let me write it down for you to note. Title of change, nature of changes, reasons and justification of change, impact of change, and what else should be? So when I say impact, sometimes the question is that what could be the impact? So it is the number, okay, adjustments and places where the change will be applicable. And finally, we also need to talk about what are the assets or liability or expense, etc., will be impacted as well. Because sometimes we need to talk about the entire extent, the dominoes effect, because when we make certain changes, it can be pervasive, it can impact other accounts as well, or other policy also need to change. So we need to provide the full extent of disclosure whenever there is a change in accounting policies. If we change the accounting estimate, we also need to provide the justification for that. That what suddenly made we realize that the truck should not be depreciated for 10 years, it should be depreciated for 15 years. How come suddenly the scrap value has increased? So on and forth. What was the rationale for this? Okay. Now let's do some brainstorming. I say that I'll provide some memory map, how it should look like. Other memory map you can be used to. So accounting policy, rules and conventions, selection, changes, and said that be consistent. When you change, it is required by the standard, will provide more relevant and accurate information, only then you need to change. You can't just keep changing for your own sake. Apply retrospectively or prospectively. Selection, use an IFRS standard, so have a base to change the accounting policy, and it could be management judgment. If it is management judgment, apply retrospectively. If it is forced by IFRS, then just current year and previous year, right? So this is the way you can develop some memory maps, and it's not only for IFRS. You can use this at workplace, for any other course or academic studies. These kind of things are very useful to revise and memorize things better. Moving on. Shall I do some question answers?
Sure.
Fabulous. So this is a question. As usual, it is good to first read the question before going through the details. How much should be accounted for as a prior period adjustment? What should be the PPADJ? So what should be the prior period adjustments to the account of 30th September 2008? Now go through each item 1, 2, 3, and 4, and we'll discuss this. This one
Hello.
question will clarify a lot of doubts, if any.
Hello. Hello.
Hello, yeah, I can hear you.
It's just a concern. You see, I was saying this. Before one can attempt this, you must have known IS 8. But now is a question, and without going through IS 8, how will one answer this question? Prior period adjustment and all other stuff. I don't know.
Okay, so
If we who have treated IS 8, wherein all concepts and other things we are taught, then such questions will have been easy to answer.
yeah, I agree to your point, but since this is more of a revision class or recap class, so we can't go through all the points, though I do understand that you deserve all the details, definitely, but I can still help you answer this question. So sometimes even if you hear how it is being attempted and how it should be answered, you will still learn. But since it is a revision class, so we cannot go into the entire set of the details. Yeah,
I got you.
So let's see, and I'll discuss and help you with the right approach. So a claim for tax relief submitted in 2005 was rejected by the tax authorities. So on the face of it, it is not legitimate adjustment. You agree or not? The company had originally expected the claim to succeed. The company had also decided to include, so let's highlight the key point and then we'll come back. The company decided to include attributable overheads in its inventory valuation for the first time in 2008. The effect at 30th September would have been to have increased inventory by 5,000. So we are not talking about the prior period adjustment here, right? The company has decided to include attributable overheads in its inventory valuation for the first time. The effect at 30th September 2007 would have been to increase the inventory by 5,000. So a relevant sentence here to highlight. A cutoff error. Look at the word error. Was discovered, which would have been reduced the value of inventory by 24,000. Oh, so look like that. If we had encountered this earlier, our reserve or the entire value would have gone down by 24K. Now, obsolete inventory had been written down to its estimated net reliable value at this. All right. Point number 4 is saying there is some inventory which has gone obsolete. And when we sold it this year, right? The entire value has been already adjusted because now it is sold. So since it has been sold now, it is already has given the impact to the current year financial statement. So our overall adjustment required for the year is 24 plus 10K. So it will be 34K because a cutoff error which has happened here. So cutoff error reduce the value of inventory. Okay, so reduce the value of inventory by 24K. Second thing that we need to also reduce, point number 3. The company had decided to include attributable overheads in its inventory valuation for the first time in 2008. Effect last year, right? We are talking about the prior period adjustment. So everything that has happened last year would have been to have increased inventory by 5,000. Oh, so if we had that foresight last year, we would have increased the value by 5K. So increase the value by 5K. Point number 2. Okay, let's go by 3. A claim of tax relief. See, the company is saying company had originally expected to claim to succeed. The claim should have succeeded. So company would have already assumed that it will succeed. But what has happened? The tax authority has rejected this. So increase the liability. So the overall impact will be negative, right? 15K. Point number 1. What is the net impact? Any question? Are we good?
Yeah, Nilesh.
So this one question but it gives you an overview how we analyze the prior period adjustment or the current year adjustments for IS 8. I do understand it is a tremendous or big standard and it will require a lot of time to discuss. Typically in one session I spend on this, it goes up to 2 hours to cover all the salient points. But this is just a quick overview. Now we can move to another statement, another standard. Let's cover quickly IFRS 1. IFRS 1 is about first time adoption of International Financial Reporting Standard. So when we adopt first time IFRS 1, first time adoption, what do we do? First of all, the first thing that we need to understand, recognition and derecognition. Because imagine, let's take for example a US GAAP based account financial statement, okay, and you are converting that into IFRS. Let's start from there. What will be your concerns as the auditor? You should first say that, oh, okay, so Nidhi, you had accounting standard in US GAAP earlier, so the asset, liabilities, or for that matter even revenue or expense which was recognized earlier in US GAAP may not be recognized in IFRS as well. So first we need to go through each line item to check which one is recognized and which was is de-recognizable. So maybe we need to get rid of some of the asset or liability, or maybe we need to recognize some additional liabilities. I'll give you some example. If we are doing the lease accounting, imagine under US GAAP versus under IFRS, there'll be a lot new liabilities to be recognized or new more asset to be recognized under IFRS. Because how IFRS treat, let's say, just to make the point clear, I need to introduce to you some concept of lease accounting. Okay, so under lease accounting in IFRS, if you are suppose paying 10K per month to say anyone's name, maybe Nidhish and company, okay, you are paying me 10K per month for a plant every month, right? So in a year you are paying 120K, and how many years you are going to pay? 10 years, and you take a 10% of cost of capital, so 120K for 10 years, right? 120K, just let me write 10 times if I can. Okay, so you need to take the present value of all this cash flow. How much it would be? Anyone? It would be around 0.9 million. Okay, at the 10%. Now this 0.8 million, generally if you are reporting in the US GAAP, you can just report as an expense of 10K. Do you all agree? Oh, look like you're shy, but anyway. So let's imagine
could you please repeat this one, paying 10K and this, a bit confused in this.
Okay, fine. Imagine you have a factory and I have provided you a plant. Okay, that is on lease, and you're supposed to pay me 10K per month, okay, for that plant. So 10K per month means 120K per year.
Correct.
And you are going to pay me 10 years for 10 years. So if you pay me all the 10 years, what will be the present value of all the cash flow that will come in future? How much it will be worth today? It will be around 0.8 million if you take a 10% of the cost of capital, right? This is how we calculate the present value of something, because money in the future is not same equally valued as of today, right? If you pay me say 100,000 after a year, I would value that like a 90,000 now, isn't it? Because of the interest, inflation, so many other factors. So we take a present value of all the cash flow that you're going to pay to me in next 10 years.
This is IRR NPV?
It's not IRR NPV, but similar concept. So you use the cost of capital of the organization and try to track the present value. So generally the present value is taken like this. Let's say year 1, 2, 3, 4, 5, 6, 7, 8, 9, right? And you're going to pay me 120K per year. So I will take the present value, which is like 120K divided by 1.1, then 120 divided by 1.1.2, then 120 divided by 1.1 to the power 3, and all the number that will come here is like 10 or maybe 98K or maybe 90K. All the number that comes here, that will be the present value, okay, which I am estimating as 0.8 million. So the point I'm trying to make is, this is your net liability, isn't it, to me? You are going to pay me this much, yes or no? Don't worry, I will not ask you this money anyway, but you are going to pay me this, right?
Okay.
So this 0.8 million that you are going to pay if you're going to run the factory, right? This is like a liability from you to me. You owe this liability to me in reality. Whatever accounting method, whatever the accounting standard says, in reality, that is the fact. So IFRS says that don't follow what US GAAP was saying. You have a liability to Nidhish to the extent of 0.8 million. And you need to show this as a liability of 0.8 million. Now, you will argue that, oh, how come I have not taken any asset or I have not signed any agreement of liability? How can one impose liability on me of 0.8 million? Then I will say, okay, fine. IFRS also says that you have an asset of 0.8 million at the start of the agreement, because if you're going to pay me this 0.8 million, yeah, you're going to pay me this also means that you have a plant which we are using, that is also yours then, because you are going to ultimately benefit from that plant, right? The plant I'm talking about in your factory, who is going to take the economic benefit of that plant? It's you, right? Hello? Are you still with me or confused anywhere? So the point is, if there is a liability to me to the extent of 0.8 million, IFRS also asks you to recognize an asset to the same extent of 8.8 million. And IFRS assumes that you have an asset and you have a liability if you have made a commitment to somebody to pay this much amount in future. Okay, so you need to recognize an asset, you need to recognize a liability, both. And it is fair, it makes sense, because ultimately you are the beneficial of that plant, right? The plant we are talking about earlier, the plant you took from me and you promised to pay me 120K per annum per year, you are going to get the benefit, right? And what is the definition of the asset? Future economic benefit. Are you not going to get the future economic benefit? If yes, then you have an asset.
Correct. Correct.
Are you not going to pay me for next 10 years? If yes, then you have a liability. So you have asset and liability both. In both angles, it is fair. Earlier, accounting standard like US GAAP was not asking you to recognize asset and liability, but IFRS is asking you to do that. What did we learn from this? We learned that IFRS may ask you to recognize additional asset, additional liability. Or in some cases, IFRS may ask you to remove that asset or liability, or even some income. That means when you start applying IFRS as per IFRS 1, you need to reconsider recognition and derecognition. Derecognition is when you have an asset, or suppose, for say $1 million, and as per accounting standard or IFRS framework, you have decided to remove that asset from your balance sheet. That is called derecognition. And IFRS has loads of strict criteria where you cannot easily recognize an asset as well. So you have to de-recognize some of the asset, or maybe some of the liability as well. You have to remove, right? That means you have to really analyze each and every number in the balance sheet, in the P&L, in cash flow, and accordingly decide whether it should stay or it should be gone. So the recognition and derecognition need to apply from the start. What else? You need to have more standard notes. What are standard notes? Disclosures, market risk, credit risk, liquidity risk, offsetting tables, derivative risk, currency risk. So many different risk tables you need to prepare, which might not be in the earlier statements. Then you need to prepare interim reports as per IAS 34. So IAS 34 for interim statements. Let me give you a short note on how different kind of statements are copied. So all the assets need to be mapped under IFRS, which one? 9 and 13. Liabilities. And why this summary is important? Because eventually all these standards will be aligned with IFRS 9 when we are preparing the financial statement, because IFRS 9 is just a one single standard which ensures that you have considered each and every item as per the specific standards. What are the specific standards? IFRS 9, IFRS 13, IAS 32, IAS even 39 is gone, but all these are the main standards that you need to consider before you say, oh my god, my liability is done and my asset is completed. Before you gain confidence, you need to check for all these standards. Offsetting tables, that is also need to follow IFRS 9. Intangible assets, IAS 38. Then we have cash flow statement, specifically following IAS 7. Balance sheet, P&L, all these statement of changes need to follow IAS 1. Then we need to apply IAS 19 for the defined benefit, derivative, asset and liabilities need to be considered. So especially when we go into the derivative, the world is much more different between other standard and IFRS. After advent of IFRS 9, the way we classification of derivatives are different from IAS 39. Now we have different nomenclature. Also, embedded derivatives, they need to be treated separately and need to be valued separately as well. So if suppose that embedded derivative, like you have a bond, and in the bond there is an option for you to convert the bond into equity based on a specific price. Say you have a bond of $10 million, which can be converted at the rate of $1,000 if you wish. So what is this? This is a fixed income. The bond is a fixed income, but this option to convert into the equity or shares, that is not a fixed income. This is an option. Now if you have an option, then you have to value this, right? Some of you might have heard of Merton Skoll Black model, and there are many other models, binomial models, several models to value the option. So you need to value the option separately and put that under the derivatives. So that means standard to standard, the treatment of these derivative and financial instruments are completely different. How we disclose it could be different. Hence, IFRS 1 asks you to reconsider the header, the footer, the classifications. Now, it is not only about the recognition and de-recognition. How do we classify the assets? That is also important. So let's say classification. What standards are covered. What standard covers this? IAS. It was earlier.
913.
Which one? 9?
913. Prior which you mentioned.
No, so 9 and 13 is more for recognition and derecognition and valuation. Okay. So classification and disclosures are still governed by largely IAS 32. Okay. And IFRS 7, which talks about the disclosures. Okay. What do I mean by classification then? Let me distinguish this first. So imagine you have a preferred share, right? Generally, many people think that it is an equity. IFRS said no, this is liability or a debt, because the inherent nature of the preferred share is of a liability or a bond that you have issued. So suddenly your equity converts into debt, isn't it? Big difference. So the classification can be different. Your entire balance sheet P&L can go, like upside down if you convert from one accounting standard to IFRS. And these are the salient point that we need to be careful of and need to apply each and every different accounting standard. So pension accounting I talked about, IAS 19 for pension. Then comes the provisioning. That is another key aspect for IFRS, because as per IAS 37, you might need to realize so many different kind of expense and liability as per the provisions. Not only this, if you are in a mining business and you think that after you complete your business, you might need to pay 1 million to government in order to reinstate the damage to the environment, and that 1 million you need to take the present value of that today, it might be say 7.75 million. So this is a liability that you need to recognize and you need to provision for that liability. In many other accounting standards similar to US GAAP, it is not compulsory as of now, but in IFRS you might have to have new expense, new liability. So need to check for all such accounting standard and recognize, de-recognize as the need be. There are some exceptions as well though. What are the exceptions which is not part of the IFRS 1 strictly? Anyone? So one of the exemption is that when it comes to the retrospective application of IFRS for hedge accounting, say derivative accounting, you don't need to apply the retrospective valuation. So if you decide to change hedge accounting, or if you have a derivative valuation changes, basically you don't need to apply this when you are adopting it first time, because what happens is you are adopting say US GAAP or even Singapore GAAP, right? And you are doing it first time, right? Because you are doing first time, you are bound to have difference in accounting methodology, right? So there is an exemption. You don't need to do the retrospective valuation for all these complex financial instruments. These are very complex financial instruments. You are bound to have the difference in the valuation methodology. So there you have relief from IS 8 requirements. You don't need to do that retrospectively. An important relief. Any question? Anyone?
Good to go.
All right, great. So we are at the, almost at the end of 2 hour. We have gone past 6 p.m. So we can stop it here and we'll regroup tomorrow.
Sure.
All right, and if you have any question from today's session, you can note it down. We can discuss that tomorrow as well, and we'll endeavor to at least cover 3-4 statement. Today's statements or IFRS was quite long, so it took relatively longer time. But it is better to just discuss and clarify all the doubts rather than just making the progress without substance. So let's regroup tomorrow and continue this.
Okay. Thank you, Nidesh. Thanks for your time.
Thank you, Ganesh, and thanks everyone. Thank you for your time and discussions. See you tomorrow.
Thank you so much.